Hello everybody, welcome to our Finance and Managerial Accounting module. It's me, Abdulrahman J.K. Alfar, will be with you during this course. So our first week will be to discuss the Finance and Managerial Accounting module, and mainly we will provide a general introduction for accounting and finance. Then we'll move to discuss the statement of financial position, or what known as the balance sheet. The outlines of this week's lecture: we will start with a discussion by defining accounting. Then we'll move to illustrate who are the users of the financial information before we discuss the three different financial statements. Afterward, we will move to discuss the statement of financial position, its components, layout, and uses. So first of all, what is accounting? Accounting is founded in order to identify, measure, record, and communicate information with stakeholders. Identify, it means determining what transactions to be recorded, to identify the events which are to be recorded, in other words. While measuring, it means quantification. So the quantification of business transactions into financial terms by using a monetary unit. If an event cannot be quantified in monetary terms, it is not considered for recording in financial accounts. The third phase of accounting that we have is recording. Once the economic event is identified and measured in financial terms, these are recorded in books of account in a monetary terms and in a chronological order. The fourth phase of accounting is communicating. The economic events are identified, measured, and recorded in order to share or communicate with managers and internal and external users. These users, we call them the stakeholders. After a while, we will start to define what do we mean by the stakeholders. So now let us move to discuss what is finance. Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. So we have to understand different forms of finance to understand costs, benefits, and the risk associated with these forms of finance. Mainly we have three types of finance: the personal finance, the corporate finance, and the public finance. During this module, we will only focus on the corporate finance. So who are the main users of the financial information in any organization? Or in other words, who are the stakeholders of this company? A stakeholder is any person or entity that has an interest in a business or project. Stakeholders can have a significant impact on decisions regarding the operations and finances of an organization. Here we have several examples that identify who can be a stakeholder for a certain company. We have the owners, customers, competitors, managers, lenders, suppliers, and the government. And also we have different stakeholders for other organizations. So now you can start to think about your own organization and to think who could be the stakeholders of your organization. Now let us move to discuss the financial statements. The financial statements are essential for any businesses to manage and develop. We define the financial statements as written records that convey the business's activities and the financial performance of a company. Financial statements are often audited by government agencies, accountants, firms, and etc. to ensure accuracy and for tax financing or investing purposes. These financial statements include the income statement or the profit loss account, the statement of financial position or what we call the balance sheet, and the cash flow statement. So now let us move to discuss the statement of financial position or the balance sheet. The statement of financial position shows the financial position of a company. It provides an overview of the assets that owned by the company, its liabilities, and the owner's equity. In this lecture, we are going to discuss the statement of financial position, illustrate what do we mean by assets, liabilities, and owner's equity. In the following lectures, we will move to discuss the income statement and the cash flow statement and to use some financial ratios that will help managers to make some decisions. For instance, the general formula of the balance sheet or the statement of financial position, the total assets will equal all the time the total liabilities and the owner's equity. The income statement, unlike the statement of financial position, the income statement covers a period of time. Usually this period of time is a year or a quarter. The income statement is known as the statement of profit as it provides an overview of revenues, expenses, and net income. And we have a general formula for the income statement. The net income equals the revenues minus expenses. And of course, we have different classifications for expenses. So we will have a different forms of profits. But for now, we will provide only a general introduction about the income statement. The cash flow statement. The cash flow statement measures how well a company generates cash to pay its obligations, so the debt obligations mainly, and how this company will finance its operating activities and how they will provide fund to their investments. The cash flow statement, it is a complement statement for the balance sheet and the income statement. And we can classify the cash flow statement into three categories: the operating activities, the investing activities, and the financing activities. Before we start our discussion of the statement of financial position, here we will provide some some differentiation between the three different financial statements. The income statement and the statement of the cash flow measure flows during a period of time, while the statement of financial position or the balance sheet is for a particular moment in time, so it is a snapshot. The three statements together are referred as the final accounts of the business. So any business needs to prepare these accounts. Now let us move to discuss the statement of financial position, or what is known as the balance sheet. The statement of financial position follow a general formula. The total assets equals the total liabilities plus the owner's equity. So in the statement of financial position, we have three main categories: the assets, liabilities, and owner's equity. Now we will move to start to discuss the assets. So an asset is an item that the company owns with the hope that it will generate future financial revenue. So we have different types of assets, but mainly let us start our discussion by differentiating between the tangible and the intangible assets. The tangible assets, these assets that we can touch, so this is a physical assets, while the intangible assets, it is not physical assets. The examples about the intangible assets are intellectual properties, patents, and the goodwill, while the tangible assets can be classified into current assets and fixed assets. The current assets are those assets that you expect to either convert to cash or to use within a 1 year, or at least one operating cycle. And it includes cash, temporary investments, accounts receivables or trade receivables, inventory, prepared expenses, etc. While the fixed assets, or sometimes we call it the non-current assets or the long-term assets, are those that you use in the operation of your company and that will continue to offer benefits beyond a single year or operating cycle. These fixed assets can include the long-term investments, land, buildings, machines, equipment, furniture, vehicles, and more. While when we move to discuss the liabilities and the owner's equity, the liabilities are the amounts that the company owes and will have to settle in the future. The current liabilities are those that are expected to be settled within 1 year or one operating cycle. And some examples of the current liabilities including the accounts payable and the demand loans. While the long-term liabilities include ongoing commitments such as loans, mortgages, long-term financing arrangements. So these are liabilities. While the owner's equity is made up of two main components, the capital and the retained earnings. The capital, it is the amount of money that owners have share at the beginning of the project, while the returned earnings are the profits that has not been distributed among the owners in the previous years. This is the full map of the statement of financial position, and you can see that we can start from the assets, liabilities, and owner's equity, and under each classification we have the subcategories that could be part of the statement of financial position. So this is the general layout of the statement of financial position. This balance sheet for a company, and we can see here that this company provides we can see that we have here some fixed assets such as property, vehicles, furniture, and here we have the total fixed assets. Also, we have some current assets such as bank accounts and debtors or account receivables, and here we have the total current assets. When we sum up the total fixed assets and the total current assets, this will give us the total assets. After that, we will have here the current liabilities, creditors, value added tax, wages, and then we will have the total current liabilities, which is the summation of all the previous items. And here also we have the long-term liabilities, such as creditors long-term, and this is the amount of the long-term liabilities. So this is the total liabilities that we have, the summation of the long-term liabilities and the short or current-term liabilities. Also here we have the equities, the capital invested, and the profit that have kept an account in the previous years. So this is the total owner's equity. And when we sum up the owner's equity with the total liabilities, it is a must to equal the total assets. So what is the purposes of using the statement of financial position? Or why is the statement of financial position important? First, the capital structure in any company consists of two channels: the owner's equity and debts. The statement of financial position enables us to explore the capital structure and how these funds of capital are deployed. The second reason, or the second importance for the statement of financial position, it explains the financial position and the value of the company, so we can evaluate the real value of the company. The third importance, the statement of financial position data can be used to analyze the interactions and the relationships between assets, liabilities, and equities. This is the end of this week's lecture. Thank you for your listening.